So we have three excellent panelists here this morning. We're going to move from the technology side that we saw pre-break into how we're going to finance all this and how's the financing at the moment. But I want to begin by asking each panelist to really introduce themselves and the work that they're doing in relation to this topic of financing energy tech. So perhaps, Nikita, you could go first.
Good morning, everyone. Can you hear me all right? The back? Okay, great. I'm Nikita Singhal. I'm the co-head of responsible investing in ESG at Blue Owl Capital. I've spent the last 20 years at the intersection of sustainability and investing, so really excited to be here today. In my specific role at Blue Owl, I think I'm very privileged to sit at the intersection of sustainability, but within investing, both responsible investing and infrastructure. And I think this is particularly a very interesting time, especially for us at Blue Owl, as we're one of the largest financiers of digital infrastructure in the country, at some point possibly the world as well. What I find most exciting is that this is an opportune time to think about sustainability issues, not as value considerations, but really as issues that are impacting businesses, impacting asset value, impacting resilience, impacting project finance. And so it's really not a political view, it's not a moral view, it's something that we can earnestly urge Wall Street to think about how to price these seeming, externalities into the work we do.
Thank you. Chris.
Good morning. My name is Chris Creed. I'm a managing partner and co-head of credit at Galvanize Climate Solutions. Galvanize, very quickly, is a asset manager. It's about 5 years old, founded by Tom Steyer and Katie Hall, solely dedicated to the thesis that there are excess returns in investing in the future of energy and climate solutions. We have a bunch of different verticals. I run the credit vertical. Prior to joining Galvanize about a year and a half ago, I was the chief investment officer of the U.S. Department of Energy's loan office. We obligated about $108 billion in 57 transactions under the previous administration. And then before that, the joke that I use is I was incarcerated at Goldman Sachs for 21 years. Wonderful experience, learned a lot. I ended up being the co-head of structured credit there. I managed about $100 billion in assets at GSAM. It's a pleasure to be back at Columbia, and I thank Bruce and the team for inviting me. Thank you.
Thank you, Chris. Vijnan.
Thank you, Bruce. Thank you for having me. I'm Vijnan Batchu with JP Morgan Investment Banking. I run a group called the Center for Carbon Transition. It's an energy transition group, and we are part of a broader group called Corporate Advisory and M&A Advisory. So basically, our broad group focuses on providing advisory services for corporate clients. We obviously talk to investors as well. And as part of that, we provide not just M&A advice, but advice about decarbonization, advice about ratings. The infrastructure finance group is part of our group as well. So that's the broad group. I've been with JP Morgan for 24 years at this point in time. And my specific group effectively focuses on three things. One is the topic of energy transition is pretty large, but there's always some topical elements within that. So for example, we are spending a lot of time on thinking about, okay, what's the impact of the conflict on energy transition? And where could business opportunities in banking open up? We are a global platform, so that's one thing we do. The second is obviously the one which is the most obvious, work with clients, existing large cap clients, but new clients to help them raise capital. And third is JP Morgan also has a financed emissions goal. It has a $1 trillion green target over 10 years. So sitting in the investment bank, we quarterback that effort. So again, Bruce, thank you very much for having me. One last thing, the views I'm going to state are my personal views, they're not JP Morgan views. And again, thank you for having me.
Very good. Welcome, Vijnan. Perhaps you could just move your mic up just a little bit on your lapel, be a little louder. Thank you. So let's open up discussion now. And the topic I'd like to begin with is what is the opportunity in financing energy tech for each of you and your positions and where you're looking at the market? What's the opportunity in financing? And also, what are some of the challenges that are immediate at the moment? Perhaps Nikita could start us off.
Yeah, I mean, I think, inherent in the challenges are the opportunities. I think if you look for the challenges, those are the most exciting opportunities. People obviously are more focused on the direct opportunities energy technology. We'll hear some of that today. Advanced nuclear, really exciting geothermal. I think you just heard about that earlier this morning. There are technologies that are being pulled forward because of this significant demand for power today. But what I'm here to argue, perhaps sitting on the side of finance, is that as the demand for power is growing faster than the availability of infrastructure, I see the opportunity as financing the picks and shovels in electrification and in digital infrastructure. So I think some of the most interesting opportunities in energy technology are in grid upgrades, transmission and interconnection solutions, storage, distributed generation, and behind the meter solutions, which I'm sure we'll hear from Chris as well on, and then generally power infrastructure for large load customers. So I think that the best energy opportunities probably sit between traditional categories. And it's really interesting for us sitting on the finance world, because what is unique about this opportunity is that we don't have traditional financial structures to meet those financing needs. So you're not going to, you're going to have either very capital intensive or asset heavy industries that might be too much for venture financing. You might have something that's too novel or contracted very differently to be suitable for infrastructure debt. You might have projects that are too execution heavy, which doesn't look like software margins for a tech fund, or you might have projects that are too dependent on permitting and offtake agreements, which are not good for generic private credit. So we're sitting at this very, very interesting time right now, where the capital structure matters as much as it does for the technology selection. So as much as we can debate what's the right technology for us going forward from an energy transition standpoint, getting the right capital structure and financing structures, which I'm sure many of you are studying in your climate finance classes, is equally important.
So just to clarify on that for a second, this is like the value of death. Sometimes people refer to that, right? The gaps in financing. And do you see that those so-called value of deaths or the gaps, that's an opportunity? Is that the way you would frame it?
I do, because I think in the past, the challenge was that there wasn't the demand.
Okay.
Right. And I think what has fundamentally changed is this sheer level of demand. I'm sure you've heard these statistics even earlier today. Power demand looked like a 1-2% increase per year for the US. And, it's different for emerging markets, but that we are suddenly in a very different game, and a power industry that is not used to dealing with infrastructure needs that it needs today. On the other end, you have hyperscalers who are willing to pay anything to get it's the speed to power to get these data centers up and running, to be able to train their AI models. And so that is setting up a very different economic model, which makes it feasible to do things like GPU financings, where traditionally, if you told me to finance a GPU as someone sitting on Wall Street, it's very hard for us to estimate how quickly general processing units would degenerate, how valuable they are. But we're not financing GPUs, we're financing equipment that is backed by investment-grade counterparties, and suddenly that changes the game. It's the same for context of more precipice technologies, where you're no longer just underwriting the precipice technology or taking a technological bet. You're actually taking on the creditworthiness of the counterparty that's willing to guarantee and backstop it. And so that makes it very interesting for, I think, more novel financing structures than have existed in the past.
Terrific. Chris, what are your thoughts on the opportunities and challenges that you're seeing from your position in the market?
Yeah, absolutely. And I want to say that, I very much agree with almost everything that Nikita said. Here's the framework that almost everything. No, generally speaking, that's the issue. Here's the metaphor that I have. Do you guys remember when you were children and you had these blocks and you had the square pegs and the round holes, or that famous scene in Apollo 13 where they're like, the filter's square and not cylindrical and we got to solve it? That's the problem we have right now. We've developed a financing system over the past, 30 or 40 years, but really within the past 25, where we have this idea that there are projects or companies that are supposed to be funded by the public markets, through the bonds, through the traditional private credit markets, and by that I mean the broadly syndicated bank loan markets, the CLO markets, et cetera, or the insurance and banking system. And that worked really well for a while, right? For those of you who are as old as I am, maybe ignore 08 for a second. But you then go forward and you're in a situation now where you have a square peg and a round hole problem. Now, for somebody like me, that's awesome, because then I can go to investors and say, I have an idea, square holes. Give me money, I will invest in square holes, and I'll solve the problem. But my cost of capital is, fun fact, very expensive. And so the real issue is, how do we mature companies and projects fast enough to have access to the larger oceans of capital, right? And that's the bit where Nikita is absolutely right. Because if we can figure out, instead of, to use her example, financing GPUs, let's finance Google, the markets can do that very easily. But the problem that is presented to me, and I won't use the name because, Chatham House rule and all that stuff, but large macro-sized hyperscaler X, that's bad because that's actually one. If you guys keep laughing at my jokes, I'm going to keep using them. Came to us and said, "Hey, we need to finance." So yeah, we use the demand response, or can we match load, or all these things, and they want power in 27, which, fun fact, you can't get. And the answer that we got was astonishing, which was, you do not understand the price of the NVIDIA chip. I have to have a 98% capacity factor. To which I responded, then it's not gonna work, because we're not there. And I think something's got to give. Square pegs, round holes. That's the metaphor that I think we're solving. And in my office, if you use missing middle or valley of death, it's $1 in the jar. So Bruce, I'll collect. No, but I think that's the framework.
Vijnan, from your perspective.
Yeah, so maybe I'll break this up into two parts as to what's interesting now and what could be interesting in the future. And can folks in the back hear me at this point? Okay, great. So I think in terms of what's interesting now, I'll probably sound almost identical to what Nikita said, but to me, it's the intersection of where there's obviously good business models, good customer demand. That's always a given for us. Ability to scale, bring unit costs down. But if you have an energy security lens through it, given the world we are living in, that makes it a very interesting business opportunity right now. So if you look through that lens, there's a reason we did the X Energy deal 2 weeks ago now. There's a reason why X Energy can raise capital in the nuclear space. So we're spending time on nuclear, spending a lot of time on geothermal. As an institution, we are spending time on grid infrastructure. To Nikita's point, that's a problem waiting to be solved. We're also spending time on storage, right? So all the usual suspects about where you would expect us to spend time. Personally, I've also spent a lot of time on carbon markets for 5 years, which I would not recommend is the best use of time you could have had, but we have spent a lot of time on that. We did a very interesting structure last year, the square peg round hole. We did a first of a kind infrastructure finance, project finance for a carbon project developer, where we raised about 200 million. It's not a big number, but we effectively could get like a project finance structure in a nascent market. So to me, that's interesting. And if I look ahead as to future opportunities, a lot of them people will talk about, but one of the interesting spaces for me is the food and ag space. I've spent literally close to zero time on this space, but if you look at what's happening as a result of the conflict with fertilizer shortages, the logical place where you would and for example, the Middle East imports 80% of its food, right? And if you look at how capital flows have behaved, 2021, 2022, if you have looked at any VC private equity flows, that was the peak. And since then, they've only gone one way, which is down, right? So if you look at 2025, kind of flatlined, but they're depending on whether you look at large cap trades or small cap deals, the total capital raise was about 50 to 75% down. And if you look within the ag space, the food and ag space, there was a brief burst where indoor farming got like a big lift, alternative proteins got a big lift, but everything subsided. But if you look forward, I think, what does the world need? There's the massive fertilizer shortage, which is going to happen. You need companies which can deliver targeted fertilizers. You need better crop yields. You probably need vertical farming, alternative proteins, because there's a real problem. That's an area I would love to spend time on going forward.
Terrific. There's been a lot of talk about power needs and demand side and fitting square financing pigs into round holes. But I don't think any of you mentioned the word climate, and we're at a climate conference. So how does all this activity, how does it intersect with our need to reduce emissions, sustainability more broadly? How do you add that another layer of complexity into your thought about this opportunity and the work you're doing? And then to all three of you, as you wish.
I'll start with just a bit of a tangential anecdote. But when I was interviewing for my last job, I was head of ESG at Lazard. I remember telling the CEO that my indication of success will be that you don't need me anymore, because the idea that every investment professional on Wall Street is thinking about climate and is actively integrating it into their work, right? I see that as my life's purpose, where it's not just for the evangelists, it's not just for the tree huggers, it's for all of us, and especially for those who are going on to work in finance, to recognize that environmental social factors do eventually get priced into the market, especially in this environment, pun unintended, through regulation, through changes in consumer behavior, and through shifts in technology. And we have seen this happen in the last 10 years. So policy shifts, which continue to be volatile in the US, but other parts in the world, I understand that carbon markets have not been very lucrative a space to be in. I sat in Professor Usher's class in 2009 when he was talking about carbon markets. I think that there is inherently an implied price of carbon. It's a different price in different markets. Understanding that is probably a huge alpha generation opportunity. So there's regulation and a huge investment opportunity there. There are real shifts in consumer behavior that are impacting how companies are valued and the multiples they trade at. We can see this in plastic manufacturers going back several years ago, where a plastics company, its EV/EBITDA multiple degraded by 2 turns during the same time period, where an aluminum packaging company re-rated a few turns up, even though EPS degradation for the plastic company was just 5%, indicating that the market is pricing in the use of single-use plastics because companies like Unilever, like Nestle, are demanding that the value chain have less single-use plastics. So consumer behavior can actually drive changes in valuation and technological disruptions, right? The MSCI ACWI index just less than a decade ago was maybe 3% directly in the sectors of electric vehicles, LED lighting, and renewable energy. The knock-on effects even back then were 25%. Today, I would argue that's much more. So all of this, I've said all of this without using the word climate, right? So it is absolutely central. And to the power piece, even more so. Today, data centers are being closed down. They're not getting permits because of concerns about water use, concerns about rising electricity prices. I can go on and probably deserves a different session on why there are significant myths in those areas and significant opportunities to mitigate those risks, but they are real risks in power generation that come. And to just, I would end it with, it is therefore equally a huge opportunity for investors who can do this in a responsible fashion and demonstrate that they can be good stewards of their community, of water, and of energy use.
Thank you.
So here's how I would frame this. If you want a number that's definitely wrong, hire McKinsey. So McKinsey has $50 trillion are required to solve the climate crisis, to decarbonize between now and 2050. If you believe that number, and I've heard anything from that to $100 trillion, whatever, we're not going to get there without one thing being absolutely true. It must be the case that the unit cost economics for whatever the investment is has to be cheaper. A lot of people ask me, what are my favorite investments? Let me answer the question that I very rarely get. What are your least favorite investments? Anything that requires Google to pay more per unit than the best-in-class thing. Because at some point in time, that's going to change. I think it's wonderful that they pay 150% for low-carbon cement versus Portland cement. I think it is awesome that they're trying to pay $125 a megawatt hour for clean, firm power. At some point in time, that stops. Or they get all the power and they're the only ones. We absolutely have to figure out, how do we get unit cost economics to be cheaper? Because then it's not $50 trillion, it's zero. Because over the next 25 years, check my math, 24 years, that what we're going to be spending that on infrastructure anyway. And that is how we have to do it. tongue-in-cheek way I'll say it is, if I'm a light green person and I think the dark green people are nuts, and the dark green people think that I'm a Republican, the answer is that the only green that actually matters is money. And if we get that done, we will decarbonize the world.
Yeah, I would 100% echo what Chris said, maybe not as eloquently, but 100% agreed. So, in the absence of a global carbon price, there's no price which there's no externality being priced. So the signal has to come from somewhere. And one of the things I said initially was unit cost. Every time we look to raise money from investors, unit cost, scale, how do you bring down unit costs? That's the fundamental question which people would always generally ask us. But there are other ways, and I think Nikita alluded to some of this, in which that signal can come. Because in the end, if you want people to change behavior about what they buy, what they use, there needs to be a signal, whether it's a consumer, it's a corporate, it's an institution. And that signal is, we are all driven economically. I mean, I'm sure we all believe in climate in some way or form, but that's not the way you convince the world to change, right? So for us, it's all about economics and scaling that. But that signal can come from policy, but that signal can also come, over time, if physical risk impacts start to creep in, if transition risk impacts start to feed in. Banks will change the way they underwrite. Investors will change the way they underwrite companies. And the risk premiums which will be asked will change. You're already starting to see some insurance costs go up in certain areas. It's not as broad, it's not as widespread, but the moment those economic signals start to become more and more frequent, then it's a proxy for carbon and climate.
I was just going to add something to that, and to the point about physical risk and insurance. Vijnan's colleague, Sarah Kapnick, it's also at JP Morgan. She was formerly at the NOA. Her papers are really, really instructive on this shift that we're starting to see. And we're seeing it at a deal level, right? As we think about insurance, as we think about where we site data centers. So physical risk is absolutely starting to become mainstream in terms of how financing is being thought of. But the point that I wanted to just add is one of the other signals that perhaps I myself have undervalued in the last decade is the signal coming from asset owners. And so when you think about some of the largest pension funds in the world, the US, but also abroad, GPIF in Japan, one of the largest pension funds in the world, APG, CalSTRS, these are pension funds that have very long dated liabilities. They inherently have a long-term horizon. For them, climate is not about just caring about the planet. It is understanding that these long-term risks have to be managed and they can't diversify away from them. So they can't just choose to invest in things that will be somehow insulated. And that policies that they're being able to set at the pension fund level has ripple effects to asset managers like us. It informs regional policies. And I have seen asset managers really think about things differently because of the messaging and essentially pressure and influence from these large asset owners. I've always argued that it's not about, in Europe, you'll always hear this term of double materiality, as if climate is somehow not material, that you need to kind of make it a double materiality thing. I would argue that the definition of materiality is just over one's time horizon. And in Europe, for whatever reason, they happen to have that long time horizon, which effectively then prices in climate, into their work. And we inherently, capital markets, particularly in the US, tend to be more short-lived, and so we don't price it in. It's understandable. If you're writing 3, 5, 7-year loans, you may not underwrite long-term physical risks like sea level rise. So there's a bit of an investment horizon mismatch here, but I just want to underscore the value of asset owners in driving this change.
I want to swing back to the opportunity issue, but from a different angle, which is, we heard from prior speakers and people are familiar with what's going on in the markets right now. You see extraordinary investment and construction behind the meter solutions. And this is pretty unusual in the sense that historically, pretty much all the major additions to power generation in the country are on the grid. And now we're seeing, with the data centers, very, very large projects behind the meter. Is this a short-term anomaly just because this, in the moment we're in, or because of these new technologies coming along, geothermal, SMR nuclear and the like, this is likely to actually be a fairly significant area of investment for many years to come. Thoughts on that?
Oh, okay. It's a great question. Here's what I would say. I think that there's a couple of different competing problems that we have in the power pricing space. The first is that the way we finance power is inefficient. For those of you who have not read The Price is Wrong by, sorry, I don't remember who wrote it. Google it. The central thesis is we finance fossil generation through the utilities and we finance renewable generation through the private markets, and we are dumbfoundedly shocked that the pricing is off. And if your WACC on this side is 6, 7, and your WACC over here is 14, then yeah, no kidding. So I think that I think Bruce is getting at a really good question, which is how do we finance power better? But this gets at what is the utilities problem. Everything comes down to solving problems. And the utilities problem is that they have timing mismatch problems everywhere. Are we under the Chatham House rule here?
Yes.
Yeah. Okay. So I was down in South Carolina. If not, then I was down somewhere in the United States. And you know, we were touring a half-built nuclear power plant, and we were very hopeful that it gets finished. I was just chatting with the you know, line guy, like been a power guy for 30 years, you know, salt of the earth guy. And I was like, hey, just out of curiosity, when are you guys going to hit your reserve margins? When are you going to run out of reserve margins here in this state? And I really, honest to God, thought he was going to say 2028, 2029, 2030, something like that. And he said, oh, we're going to hit them this summer. And I was like, just so I understand, statistically speaking, we will have blackouts in South Carolina this summer. And he goes, absolutely. So the problem isn't, it was, you know, Andrea's panel just before this, the problem is not necessarily that we don't have enough power. We don't have enough power. But the real problem is we don't have power when we need power. And simply building renewable generation by the utilities won't solve that problem. So the rate base utility, the public utility commissions won't let them do it because it doesn't solve the problem that they have. So if you want more power, which we need, that needs to be done behind the meter. And that is getting at this problem of incentives and how this works. We have to solve that issue. Will batteries help? Yes. You're welcome, Dan. But you also, my friend is the professor of batteries here. But we also need to solve the principal agent problem that we have right now.
Any thoughts on this issue, Vijnan, behind the meter?
I don't have much more to add, but I would just say I feel like, you know, this is not an official view. I feel like, you know, when you look at power generation and demand forecasts, and obviously there are some consulting companies who have it going through the roof for 2030, whether it's overall power demand or, you know, data center power demand. I just struggle with that. Like for the next couple of years, I feel like it makes a lot of sense. Beyond that, there's so many variables which could change. It's kind of very difficult to predict where that power demand will go. But you know, today, obviously, there's a shortage of available power. I won't call it shortage of power. And if you're a hyperscaler and you're trying to get access to that because of speed of power, that's a very logical solution. How that will age, not spent enough time, something tells me that more time needs to be spent thinking through the repercussions. How do you transition? Like what happens if you need access to the grid at some point in time? I'm sure the backup ways in which they're doing it, they have like 2, 3 levels of backup. But I'm not 100% sure that it's a permanent thing is all I'm trying to get at.
Yeah, I agree completely with what you said, Vijnan. Is, you know, in the past when you just had fossil fuel generation, there was some predictability about, you know, this on the supply side, and then on the demand side there was also predictability. Grids were created to peak power, right? And so most utilities, when you speak to them, they will talk about how they're designed for maybe the time you need maximum power would be like 20 hours in a year. So most of the time, these grids are operating well below capacity. So there is actually a lot of excess power available today. That is around. Is it available when needed is the question. And there's so many variables in the next, I would say, 5 to 7 years. If nuclear becomes a major aspect of our energy source, whether it's old fission that comes back, some more interesting fission that's happening at, SMRs or even fusion, it could be a complete game changer. But again, the way nuclear energy is generated, you might actually need batteries to support that, without going into a lot of that detail there. So what we're seeing right now is that it's really at a project level, depending on if there are grid interconnection issues and there are constraints there, then there might be behind the meter solutions. Over the long term, those behind the meter solutions could be helpful in other ways. And then there's also significant innovation that's happening. We've seen some of this on the demand flexibility side. And Chris's colleague, ex-colleague Jigar Shah writes a lot about this, how that might actually solve some of the challenges that we have today in terms of power. In addition to that biggest question, which is the power demand even going to be what people are projecting it to be? Because right now there's a race on training rather than inference, right? So as we think, can we believe those power demand numbers that everyone's projecting? So a lot of variables in the air to have a clear solution today.
No, I want to underline something you said, Nikita, because I think it's really, really important. Baseload power is not the same as dispatchable power. And so when we talk about the need for power, a lot of people think that nuclear will solve our problem, me being one of them. I'm a huge advocate of large light water reactors, but not for the entire grid because it's not dispatchable. And we do not have an even demand for power across the grid, yet. That's part of the reasons why I do fundamentally believe that variable renewable mixed with baseload power plus demand response or VPP technologies are actually the real solution to this problem.
I want to ask one question about technology. We haven't really talked about the conference yet. And I want to and then I'm going to follow up with sort of philosophical question about financing and where we're headed. And then lastly on careers, since you've now talked about our two largest employers, Goldman Sachs and McKinsey, in somewhat shaky ways, but we're going to talk about careers. We're going to get to that.
Sorry about that.
To wrap up. The technology I want to ask you about is batteries. And the reason I bring this up is twofold. First, yesterday there was some announcement at PJM that the queue that's being cleared, the projects are being approved in PJM. The headline news is the amount of gas being approved has jumped way up, gone from a tiny percentage to something like 40% of what's being approved. That's a big change. But when I looked at the data, what shocked me is that about 40% is batteries. So from your perspective as investors, batteries bring a lot of value to these problems, but they're also challenging to finance. They don't last as long as other infrastructure assets. Hard to get sort of long-term PPAs on them. There's a lot of issues around batteries, and yet they're an incredibly part of the solution in terms of dispatchable and everything else. So how do you think about batteries from your perspective as investors?
I think, Chris, probably you might have a more holistic answer on that. We're not seeing that at the moment, but I think I have started to hear whispers in the market of interesting financings for battery platforms. There was at least one deal announced recently. But yeah, I mean, as you know, everyday developers in the trenches, I think at the moment still the focus is the site data centers where you can find interconnections, and if there's speed to power and that bridge to power needs to be a transition fuel like gas, kind of that seems to be more mainstay even today.
No, you're absolutely right, Bruce. We're selling batteries to the wrong people, right? I mean, batteries are needed, but like, where are the batteries being implemented? They're being implemented behind the meter, either in homes or at companies or data centers or whatever. And we're asking the building owner, the renter, the homeowner to pay for those batteries and then pay us back. We are starting to see some of the utilities say, well, what if I entered into an effective PPA? It's more of a tolling agreement, but that's boring, and we'll talk about that later. But like, such that I can effectively rent the use of your battery. And we are starting to see that. A company that rhymes with Con Edison is looking at something very similar here in the New York area. And we're starting to see that, but it's burgeoning. Look across the Atlantic Ocean to England, and you're seeing the utilities signing to 10-year PPAs, and suddenly my cost of finance is too expensive for the batteries because you can get regular bank financing. And so this gets back at the square peg round hole problem, which is, the people who need the batteries are not thinking of it as power in the United States exactly right now, but they're going to, and that's going to be where the proverbial puck goes.
Vijnan, your perspective?
Nothing significant to add. Maybe two quick things. I think on the PJM side, I didn't see the press release, but I think historically they didn't actually. I think they had a 10-hour horizon for batteries, and I think then it took a long time for them to get over that hurdle. So it's good news. I've not seen that.
Yeah.
But we have had companies which are starting to effectively set up residential batteries and use that effectively as a demand side mechanism, to Chris's point.
Yeah.
And you're starting to see companies raise a significant amount of capital in that space. The second thing is, I think across the Atlantic also, I just thought it was interesting. In the UK, for example, you can lease a BYD for for effectively a subsidized amount, because the BYD can do vehicle to grid. And then you can effectively charge your car at off-peak and sell it back, and that reduces your lease cost. So I feel like there's new ways and innovations in which, and in this case, obviously, as a retail customer, I pay a lower lease cost for an electric vehicle, and there's someone else who's benefiting and can finance it at a very attractive rate.
It sounds like keeping your eye on innovation and batteries is a worthwhile area.
Yeah.
I want to ask one sort of philosophical question, then let's wrap up with a career question, which is around historically, asset-heavy industries have done very well. And for investors, they've tended to outperform, a lot of capital there. And then in recent decades, you see asset-light, the whole switch in where the returns are. Now with what's going on in AI and data centers and everything else, do we see almost a revision to the norm around asset heavy as an opportunity, or what are your thoughts on that?
I mean, I think we're seeing it. Absolutely, we're seeing that switch. My personal view is, I think, as a result of geopolitics and trying to continue to compete in the world, there is an effort towards there's competition on AI, and there's a bit of this AI race that then requires that layer of infrastructure. There's also industrial reshoring that is driving this, and in some markets, electric vehicles are driving this. So I think that refocus back to real assets is certainly something we're witnessing in the market. I wouldn't say that is definitely here to stay. Maybe there's step changes because we have a very old grid. We don't have the industrial capacity in this country that we did before. And at some point, we will start to think about all the AI innovations and productivity that we've been promised. So maybe there will be a switch back to light assets. So yeah, I think that's where we are today.
Well, I definitely agree with this. It's the thesis topic of a white paper we're going to release today or 3 months from now, depending on when it gets through editing and compliance. Here's what I would say, though. It's not just the return. Yeah, I mean, shipping in the 18th century, in the 18th century, rail in the 19th century, oil and gas in the 20th century. These were asset-heavy industries, and then for the past 20 years, right, Sequoia Ventures has crushed it. And I'd like to comment that the biggest winners of the asset-light world are fundamentally changing their balance sheets. Look at Apple and Amazon and Microsoft, and I will keep going, and look at what their balance sheet is doing. You're seeing them tremendously change the amount of debt that they have on their balance sheet. And the reason that they're doing it is they realize that they need to make real economy investments. So I don't think it's just as simple as a return on asset heavy versus a return on asset light, although I think that is true. I think it is also that the large global companies are seeing this as well and changing their capital structure accordingly.
For energy transition, you really need the asset-heavy model to succeed. The concern I have is, obviously, asset-light models have done fantastically well and scaled very well. The concern I have with asset-heavy is you need to keep returning to the market for capital over a period of time, right? It's generally not just a one-time thing. And for that, you need to show constant progress. The problem is if you raise capital at very elevated valuations very early in the process, and then you come back 2 years later and you're not hit one of your KPIs, and you have to do a down round, and you find it really hard to raise capital. To me, that's the challenge. So as a promoter or a founder, it's very tempting to raise at the best valuation at every point in time. So we'll have to see whether the valuations, for example, which are being raised in nuclear, like they're really, really good. But what happens if you want to come back 3 years down the line, right? What happens next? How will you scale it, and how will you because that's the problem, right? You need to scale to bring unit costs down. At some point in time, you have to become economically competitive. But if you raise valuations at very elevated valuations, what does that do to the cycle, especially in asset heavy?
By definition, capital heavy means a lot of capital.
Mm-hmm.
You need to be able to raise it over time. Terrific. Well, we just have a little bit of time left. Very quickly, career advice. We have many students in the audience or professionals who are maybe actually looking at perhaps changing careers, changing firms. What are your thoughts about the sector you're working in now? Any career advice you'd give?
I think shortly I would say one is, having not just fluency in one particular sector, but thinking across finance, technology, infrastructure, and policy, having an understanding across all of them, and then maybe developing your T, so the depth in that particular sector. And then just to keep it short, I would say try to be pragmatic without being cynical, because the energy transition needs idealists who understand spreadsheets, and it needs realists who care about the outcomes.
So, well, I agree with that fully. I guess one of the things that I would, I guess I'm speaking mostly to the business school, and if there are any undergrads here, the students, I think that the climate investment or let me say it more broadly, the climate solutions industry and industries are going to be a tremendous growth opportunity over the next 2 decades. I graduated from Brown in 2000, and I knew the internet was going to be big, but I didn't know if it was going to be pets.com or Google. There are going to be plenty of mistakes, right? Some of the companies that we think are absolutely rock solid today will not be here in 15 years. And and for those of you who are old, I had never heard of NVIDIA even 10 years ago. So the opportunity sets are wide. Don't think that you need to be in the right place right now. Get your reps. Figure out, if you want to do finance in particular, figure out how to finance things. It may not even be the thing you want to finance today, but if you develop your skill set and you understand things, these are transferable skills, almost all of them, and it'll put you in a place where when you figure out what that company is, or maybe it's a company you want to start, you'll have the skill sets that you need to succeed.
I agree everything with what Chris and Nikita said. Someone mentioned it, and I don't remember who, that energy transition and climate, there's effectively only 3 things which can happen. You either mitigate, or you adapt, or you suffer. Hopefully we don't suffer too much, right? So we have to find ways to mitigate and adapt. And what is hot in energy transition today, or what is not, keeps changing, right? Policies make a huge difference in this space. And sometimes the policies and the administration are supportive, sometimes they're not. It's very difficult to stay super optimistic all the time in a difficult policy setting. There's always opportunity, whether it's energy security plus energy transition. So look beyond the obvious. Things which don't look cool today could be super cool 5 years from now. And I feel like you got to use AI as a tool. There's so much information available. There's a lot of obviously private information in companies across this board, But there's just so much information available. If you just have the curiosity to go look, you'll find a lot of answers.
Please join me in thanking this terrific panel.